Hi ladies and gentlemen, this is Game of Trades, and in this video we are going back in history. It has been a while since our last video, but we're going to start picking back up the video schedule. Now today I picked out a few moments in time where the stock market has looked very similar to what we are seeing right now in 2020 with this V-shape rally. We're going to go back to different moments that are all similar in different ways, both fundamental and from a technical standpoint, to 2020. So hopefully that's going to answer the question for you, are the markets too bullish to come back down? Or is this all part of a big trick to shake out the bearish interest from retail investors like you and I? Now as we go on through the video, I'm going to try and put the 2020 market on the corner so that you can compare it to each moment in history. Now first let's talk about exactly what's happening right now with this rally. This has been a massive rally from the bottom all the way right here, a 40% rally of 74 trading days. We've had pullbacks so far on this way up, small pullbacks, but we have not had a multi-week correction so far. That's very important to remember throughout the video, because at each period of time that I'm about to show you, we had a correction, and what happened after that correction determined the next 2 years of price action. This is a very strong move, and for all intents and purposes, that cannot be perceived as anything but bullish for now. Now, does that mean you can't be prepared for downsides, for the market to go down? Absolutely not. But for now, they are bullish. We blew past the 61.8 retracement level. You can see right here, we blew past it. We came above the 3,000 point resistance level right here. And so we had the big bullish breakout that we talked about in the last video that was needed for the bullish case to firm up. Because what that does is it puts important support levels behind us, and we're going to discuss that throughout the rest of the video. Now let's get right into it, and we're going to start with the bottom of 2009. This is 2009. The market's bottomed in March 2009, and you could argue this is a W-shaped recovery, but the price action off the bottom is very similar to 2020, so we're going to call it a V-shaped recovery. Now before I go on, make sure to hit that like button. This video did take a long time to prepare. We had to spend a lot of time on the charts to look into this, so don't hesitate to show some support. Now a brief overview of the fundamental situation in 2009. Right here at the bottom, we were in an economic collapse. We had huge unemployment numbers down here, and everyone was calling out for a Great Depression. But guess what? The Fed steps in and saves the day. So you can kind of see how similar that situation is to what kind of news headlines we're seeing right now. But don't worry, it's not exactly the same, and I'm going to discuss the differences a little bit later. And you can see what happened from the bottom here. We're going to zoom in, and you can watch in the corner of the screen as I'm comparing the same price action to 2020. We had a big initial move up, then we had an uptrend, a slow grind over here, all the way to a nice resistance level. We're going to put that resistance level on here, right there, and then the markets broke out of that resistance level very impulsively, and then they corrected for a multi-month correction in time and price. So you can see that is very, very similar to 2020. We had the same type of move up, grind, and then breakout. So if we're following the same template, that would put us around over here. The markets were very overextended here, just like in 2020. So again, that would fit into the probability of having a correction. In 2020, we have not seen a correction yet. We've only seen those same pullbacks along the way up. And as you know, the markets do not go straight up. They go up, then they correct, and then they go up again. And so I'm really putting the emphasis on correction in this video because I truly believe that what happens after this correction determines where the markets go in the long term. And you can see here, after this correction, after this overextended move, we had the correction and then the markets broke out. They made higher highs and they broke out of that very significant support level. And so this is where everything happened in 2009. This is where the V-shaped recovery was completed. Now, this situation is a little bit different to 2020 in the sense that this comes on the heels of 2 years of intense bear market. So the stock market was oversold down here. This is different to 2020 in the sense where the stock market is overbought and overvalued according to many indicators. So again, not exactly the same, but the price action does show some similarities to 2009. Now let's move on to 2001, and this is going to blow your mind. Alright, so this is 2001, and we're already well into the bear market of the dot-com bubble right here. We had a significant drop over here into September 2001, and then a big move up. And look at this price action. Look at how similar that is to 2020. We're going to put 2020 in the corner right here. Just look at that. You can see that big move up off the bottom. Then we had that uptrend that formed, grinding up towards a strong resistance level. And then we had a breakdown, and you can see we had a very similar head and shoulder pattern that we looked at last week. And then we had a bounce and a short squeeze all the way to the next resistance level right here. So again, if we're following the same template, I'm not saying that 2020 will be an exact replica of this, but that would put us around right here. And so what happened from there is very, very interesting. You can see from there the markets did extend a little bit higher. They did have some more fuel to hit that 200 moving average, but then the markets corrected heavily in time. We had that correction after the big move up. Markets were overextended. Then we had that correction. And then, just like in 2009, the markets jumped and tried to retest that level. But unlike 2009, it failed here. So if you remember in 2009, we blew past right there and then we started the next uptrend. Here, the markets failed and came back down. So again, this is where I'm putting the emphasis on this video. This, I believe, is where everything happens. After the correction, which is going to be very tradable, by the way, we're going to be able to trade this in the markets. I don't think that being long here was a very good idea, just like I don't think being long right now in 2020 is a very good idea, just from a technical standpoint. But right here is where everything happened. In 2020, if we have that correction, then we bounce up and take out new highs. That's likely going to be a V-shaped recovery, and we're likely going to see much higher highs. But if they do fail, that means we put a roof on the gains that we could have on the S&P 500. Now, what's interesting about this is it really tells us that the support levels that was created here, and we can see that on the 2020 chart right there, the support levels that we created here did act as support on the way down. And so that is something that has changed compared to a few weeks ago. The markets are going to have a more difficult time coming back down if they do start to reverse to retest the lows. This absolutely will come into play when we come back down, if we come back down. Now, it is important to keep in mind the situation in 2001 is not exactly the same. We had very limited Federal Reserve intervention, so the markets were not pricing in over here. They were not pricing in monetary easing policies. And so again, these situations are very similar, but have to be taken with a grain of salt. Nothing repeats exactly, but it's going to give us a pretty good idea of what the probabilities are. Now, before we get to the Great Depression, I'm going to quickly cover the 2019 V-shaped recovery because I do think there's a lot of conclusions to draw away from it as well. This is a typical V-shaped recovery, a very powerful V-shaped recovery. You really don't see that many of these in the markets. You can go back in history, and I've done that many times on the charts. So that's why I really wanted to include this one. You can see the markets rallied all the way to all-time highs, and then we had that correction right here. Okay, before then it was just small pullbacks along the way up, and then we had a multi-week correction. And so again, same thing, and took out that resistance level. So that was the big bullish move that everyone was waiting for. Now the markets did fail that breakout right after, but from that point on, it was just a series of higher highs and higher lows. Now it's important to keep in mind that this drop was much smaller than 2020. So of course the markets did have less work to be done to the upside to get back to those all-time highs. And we had that V-shaped recovery thanks to a trade deal between US and China and the Federal Reserve lowering back the interest rates. So those are the two main things that sparked that V-shaped recovery. And a quick comment on that is that the US and China trade deal that was priced in here throughout this entire big move up in the markets is now very likely damaged. Both China and the US right now are taking steps back away from this trade deal. And that's very interesting considering the fact that we're actually above the price level where we had priced in that trade deal. So now let's get to the Great Depression, a very interesting moment in time. Now for the Great Depression, I had to use the Dow Jones, and the setup is a little bit different because of how far back the data goes. But I do think it is very important to include 1929 because it's the only crash that I've found to be so similar in terms of the magnitude of the initial drop down. And you can see the initial drop down from the top all the way to the bottom is a 50% move down. So a very quick, very powerful move down, which is very similar to what we saw during the month of March. And so again, same thing, we had that big bear market rally off of that low. And this is actually very surprising because it doesn't look much on this chart, but this move from the bottom here all the way to the top of the bear market rally was a 50% move up. This is absolutely massive, and this is during a period of 6 months. So imagine the kind of news headlines we would see with that kind of recovery. 6 months of uptrend and a 50% move up off the bottom. And what's very interesting and a little bit amusing is that we had unprecedented Federal Reserve intervention right here. And so this was absolutely massive intervention compared to anything the markets had seen before. And that's what likely sparked that big bear market rally instead of just seeing just more downtrend. Of course, it is important to know that the Fed does have much more power right now in terms of what they can do with monetary easing policies. So take all of this with a grain of salt. And I hope you guys can really draw your own conclusions from this video. I know this is not the typical video where I really try and look for opportunities in the market, but when looking at history, we have to be unbiased. If you guys enjoy this type of content, make sure to let me know in the comments and like the video to support the channel. I hope you guys enjoyed. In the meantime, good luck on your trading and see you next time.